In June 2014, China crossed a line most people didn't even notice. Its foreign exchange reserves hit almost $4 trillion. Let that sink in for a second. At the time, that was more cash on hand than the entire GDP of Germany, the fourth largest economy on Earth. But here's the part that barely made headlines. China didn't stop there. According to research by Brad Setzer from the Council on Foreign Relations, China quietly stockpiled another $3 trillion in what experts now call shadow reserves, foreign currency hidden inside state-owned banks and financial institutions. Put it together, and China was sitting on roughly $6 trillion in deployable financial firepower. And while Wall Street was busy blowing itself up in 2008, China was doing the exact opposite. This wasn't luck. This wasn't an accident. This was a long game. And the real question isn't whether China outplayed the West. The evidence is already in. The real question is how they did it tanned. What it means for a global financial system we all assumed was permanent. This is the story of the most disciplined financial strategy of the modern era. The system China studied to understand China's playbook. We need to rewind to July 1944. In a small town in New Hampshire, 44 countries met at the Bretton Woods Conference. The deal was simple: peg global currencies to the US dollar and peg the dollar to gold at $35 an ounce. That agreement made the United States the center of global finance. For almost 30 years it worked. Then came August 15, 1971. President Richard Nixon pulled the plug on gold convertibility. The dollar officially became fiat-backed, not by gold, but by trust in the U.S. government. This unlocked what economists later called exorbitant privilege. America could print money, run deficits, borrow endlessly. Everyone else had to earn dollars through trade and stash them as reserves. For decades, this system defined global power. But China was watching, and it spotted the weak point. The entire structure depended on trust in U.S. treasuries, trust in dollar liquidity, trust that there was no alternative. If that trust ever cracked, the whole system would wobble. 1997. The wake-up call. China didn't learn this lesson in theory. It learned it the hard way watching its neighbors collapse. In 1997 and 1998, the Asian financial crisis wiped out Thailand, Indonesia, South Korea, and Malaysia. Capital fled overnight. Currencies collapsed. When those countries went to the IMF for help, they paid the price in austerity, privatization, and lost sovereignty. At the time, China's reserves were barely $140 billion. Beijing got the message loud and clear. In the modern financial world, reserves equal independence. No reserves? You answer to Western institutions? That's when China locked in its strategy. Hoard foreign currency at a scale never seen before. Spread those reserves across institutions to stay under the radar. Use them to build an alternative financial system, not to consume. WDO. The turning point, December 11, 2001. China joins the World Trade Organization. This was the inflection point. Chinese exports exploded. Some categories grew more than 200% in 6 years. China became the factory of the world. But here's what made China different. Most export economies let their currency rise. China didn't. Instead, the People's Bank of China stepped in. When exporters earned dollars, euros, or yen, the central bank bought that foreign currency and issued new yuan in return. That kept Chinese exports cheap, and it flooded China with foreign reserves. In 2000, reserves sat at $165 billion. By 2006, they crossed $1 trillion. By 2013, nearly $4 trillion. No country had ever done that before. Meanwhile, Wall Street was playing with fire while China was stacking cash. Western banks were chasing leverage. Bear Stearns ran leverage ratios around 36-1. Lehman Brothers is closer to 44-1. Banks weren't holding loans anymore. They were slicing them into securities, selling them, reselling them, and stacking fees on top of fees. The derivatives market ballooned into the hundreds of trillions. Everyone assumed housing would never fall. Then it did. In March 2008, Bear Stearns collapsed. In September, Lehman went under. Credit markets froze. Trust vanished. The system nearly snapped. Washington had no choice. Trillions were deployed through bailouts, guarantees, and emergency lending. Wall Street survived, barely. China watched every second of it. Shadow reserves and hidden power. By 2007, China formalized its strategy. It launched the China Investment Corporation, a sovereign wealth fund that today manages over $1.5 trillion. But that's just the visible layer. According to research published in 2023, China holds roughly $3 trillion in off-balance sheet foreign assets through state banks and financial entities. These shadow reserves serve two purposes. They hide China's true firepower. They eliminate single points of failure. Add gold stockpiles. Rare earth dominance, strategic commodities. This wasn't diversification. This was insulation. Building a parallel system, China didn't just save money. It built alternatives. In 2013, it launched the Belt and Road Initiative, financing infrastructure across more than 140 countries. In 2015, it created the Asian Infrastructure Investment Bank, a direct counterweight to the World Bank and IMF. Then came the digital yuan, the first central bank digital currency deployed by a major economy. Integrated with China's cross-border payment systems, it offers a potential workaround to SWIFT and dollar-based settlement. This isn't about convenience. It's about options. It's a treasury myth. People love to speculate about China dumping U.S. treasuries. That misses the point. China's leverage isn't in selling bonds. It's in not needing to buy them anymore. It's financial independence. China can run its own monetary policy, finance global projects, support allies, and absorb shocks without asking permission. The big picture, this isn't a collapse. It's a shift. A slow move from a single financial center to a multipolar system. The dollar doesn't disappear, but its dominance erodes. And history tells us transitions like this are never smooth. China didn't win by being flashy. It won by being patient. While the West optimized for quarterly profits, China optimized for decades. $6 trillion later, the advantage is real. The only question left is whether the West recognizes it in time.